If you had invested $1,000 in Warren Buffett's investment company when it started, today your shares would be worth more than $30 million. These returns might seem unreal, but how did Buffett achieve this? The answer is that he understands what most people don't and sticks to a few key principles that you can apply in your daily life. Keep watching, because by the end of this video, you'll learn them all.
We look for three things when we hire people. We look for intelligence, we look for initiative or energy,
and we look for integrity. And if they don't have the last one, the first two will destroy you, because if you have someone without integrity, you want them to be lazy and dumb. I mean, seriously, you don't want someone who's smart and energetic. The truth is that investors behave in a very human way, which means they get really excited during bull markets, look in the rearview mirror and say, I made money last year, I'll make more money this year, so this time I'll borrow. Or their neighbor says, I didn't invest last year, but my neighbor who's dumber than I am made a lot of money, so I'm going to invest this year. They're always looking in the rearview mirror, and when they see that a lot of money has been made in recent years, they go all in, pushing prices higher and higher. And when they look in the rearview mirror and see that no money was made, they just say, this is a bad place to be. They don't care about what's going on with the actual business, and that, surprisingly, creates a huge opportunity, a massive opportunity.
I've been taught by Ben Graham to buy things on a quantitative basis. Look around for things that are cheap.
This was taught to me, let's say, in 1949, and it made a deep impression on me, so I went out looking for what I call cigar butts of stocks. The cigar butt approach is basically that you walk down the street looking for cigarette butts, and you find this terribly ugly, soggy, awful-looking cigar butt, but it still has one last puff left.
But you pick it up and you get your one puff. Disgusting, you throw it away, but it's free. I mean, it's cheap.
And then you go look for another soggy cigar butt with one puff left. Well, that's what I did for years. It's a mistake, although you do make money doing it, but you can't make much money that way. It's a lot easier to just buy wonderful companies. Today, I'd rather buy a wonderful company at a fair price than a mediocre company at a wonderful price. But I have an old-fashioned belief that I should only expect to make money on things that I understand. And when I say understand, I'm not talking about understanding what the product does or anything like that. I mean, understanding how the business's economics are likely to be in 10 or 20 years. I know, in a general way, what Wrigley's economics will be like in 10 years. The internet isn't going to change how people chew gum, and it's not going to change which gum they chew. If you own a significant chunk of the chewing gum market,
and you've got Double Mint and Spearmint and Juicy Fruit, those brands will be there 10 years from now. So
I can't predict exactly what Wrigley's numbers will look like, but I won't be far off in projecting them into the future. Evaluating a company like this falls within what I call my circle of competence. I understand what they do, I understand the economics of the business, and I understand the competitive aspects of the industry. But the biggest mistakes we make, by far, or rather, the biggest mistakes I've made, by far, are mistakes of omission, not of action. I mean, these are the things I knew enough to do, they were within my circle of competence, but I sat on my hands. And those are really the ones that hurt the most. They don't show up anywhere. I probably cost Berkshire at least $5 billion, for example, by sitting on my hands. About 20 years ago, or something like that, Fannie Mae was facing some problems, and we could have bought the whole company for practically nothing. And I don't worry about that when it comes to Microsoft, because I didn't know Microsoft.
Because I don't know it, because Microsoft isn't in my circle of competence.
So I have no reason to think I'm destined to make money off Microsoft or cocoa beans or whatever. But I knew enough to understand Fannie Mae, and I was wrong. And that never shows up in conventional accounting, but I know the cost of it. I know I let it slip by, and those are the big, big mistakes. And I've had many of them. There are great opportunities in life that need to be seized. We don't do many things, but when we have the chance to do something right and big, we have to do it. And even doing it on a small scale is almost the same mistake as doing nothing at all.
You really gotta grab them when they come, because you're not gonna get 500 great opportunities.
You would be better off if, when you graduated from school, you received a card with 20 punch holes, and with every big financial decision you made, you spent one of those punches. You'd get very rich because you'd think much more carefully about each one of them. If you went to a party and someone started talking about a company whose business they don't even understand or can't even pronounce the name of, but which made money last week, you wouldn't buy it if you only had 20 punches on that card. In regards to our wholly owned businesses, we are not going to sell, no matter how much we are offered. I mean, if someone offered us 3 times the value of something, like See's Candies, Buffalo News, or Borsheim's, whatever it is, we won't sell.
I may be wrong in having that approach. I know I'm not wrong if I owned 100% of Berkshire because
that's how I want to live my life. I have all the money I could ever need. In the end, it would only change the story of my obituary in the newspaper and the value that the foundation would have. Breaking relationships with people I like and with those who joined me because they believe it's a permanent home just because someone waved a big check in front of me would be like selling one of my children because someone offered me a big check. I won't do that, and I want to tell my partners that I won't do that so they won't be disappointed in me. More and more we're adopting this approach with certain stocks. Now, if we were chronically short on resources and multiple opportunities were arising, we might take a slightly different approach, but our inclination is not to sell things unless we become really disheartened, perhaps with the management, or think that the economic characteristics of the business have changed significantly. That happens, but we're not going to sell just because the price is too high, most of the time.
Well, intrinsic value is the number that if you were all-knowing about the future and could predict all the cash that a business would give you between now and Judgment Day,
discounted at an appropriate rate, that number would be the intrinsic value of the business. In other words, the only reason to make an investment and spend money now is to get more money in the future, right? That's what investing means. Now, when you look at a stock or a bond, for example, a US government bond, it's very easy to know how much you will get back. It's written on the bond. It states when you will receive interest payments and when you will receive the principal amount. So, it's very easy to calculate the value of a bond. It can change tomorrow if interest rates change, but the cash flows are printed on the bond. The cash flows are not printed on the stock certificate, and that's the analyst's job. To transform that stock certificate, which represents a stake in a business, into something like a bond and say, this is what I think the company will pay in the future. And what you really want, of course, is for the company to be able to use the money it earns to generate higher returns as time goes by. Berkshire has never distributed anything to its shareholders, but its ability to distribute increases as the value of the companies we own increases.